Trend lines are often misunderstood, and a lot of people just trade them blindly. This can lead to unnecessary losses. So, in this video, we'll cover everything you need to know about trend lines, including spotting fake breakouts, characteristics of a true breakout, and trading trend continuations. So, what is a trend line? A trend line is a diagonal support or resistance level that is drawn by connecting a series of swing highs or swing lows during a trending market. You see, markets will move in a direction of the trend, followed by a retracement. As price action develops more in the chart, we will have a few areas of swing highs or lows that we can connect with each other to create trend lines. This diagonal line that we've connected with the swing lows will be our support level. Remember, not to just take a trade based on a trend line. Always look for more confluence, like key support levels lining up with your trend lines or fib levels. Most people draw trend lines incorrectly, so I'm going to show you how to do it right. You will need a minimum of 2 significant anchor points that line up and connect. Make sure to pick out the obvious tops and bottoms. These should be swing highs or swing lows with a clean move away in the opposite direction. Now, typically, you'll draw the trend line by using the wicks, as these often work best. However, the candle body can work as well in some cases, but try to just stick with one of the two and be consistent. Don't switch it up to fit your bias. So why should we use trend lines? As we mentioned earlier, trend lines can act as an additional level of support or resistance. Trend lines highlight certain areas and offer opportunity that we might not have gotten if we didn't draw the trend line. Now keep in mind, you don't just enter a trade again based on a trend line. You'll need other tools and data to support your decision. The second reason why people use trend lines is because it offers signals or hints to potential trend reversals. Whenever a market breaks through a trend line, it can mean one of two things. The first thing is a fake out. It can deviate just above or below a trend line, making people think a breakout is coming, but then it often moves in the opposite direction, trapping those breakout traders. Now, usually when this happens, you can see the candles are still relatively small at the breakout, meaning there's no real intention of breaking out. So the best thing to do in this situation is to anticipate the fake out and enter once you have confirmation. The second thing is a trend line breakout. The difference between the fake out and the breakout is the size of the candles. If you notice large, energetic candles breaking through a trend line with new candles continuing the move, then it's likely a breakout. For even more confirmation, you can wait for it to create a second break of structure. So, wait for the market to break its first swing high, creating a new higher high. Then, this new higher high should be broken once again. This establishes a series of higher highs and higher lows. Enter on the newly created level, like an old support resistance, and ride that trend to maximize your profits. Now, we'll go over a few examples that are going to help you drive this point home. In the first example, we'll cover a trendline breakout trade. Here you can see an uptrend as indicated by the higher highs and higher lows. At one point, it started to go sideways while also making lower highs. We can connect these highs to create our trend line. Now keep in mind that the prior trend was bullish, and price moving sideways for a long time, we can expect an impulse move in the direction of the trend. So wait for price to break out of the trend line with an impulsive move. Then wait for price to break once again past this high to paint a new higher high. This confirms the bullish momentum, and you can enter on the newly created fair value gap and retest of that high. But what about fake breaks? Here we have 2 obvious points of swing highs that we can connect with each other. As the price action develops, we can see it approach the trend line with a third touch. Now it looks like price is breaking out of the trend line with 2 up candles, closing above the trend. Some of you might be thinking that this is a valid breakout, but you always have to keep the other side of the trade in mind. Because if you look closely, this move up wasn't actually that energetic or explosive. If we look to the left, we can see this down move with candles double the size of the current move up. We also have equal highs right here, which is an area of liquidity. So with this in mind, you want to wait for price to develop more and show you more information. Be demanding. Here we can see that it did go down from these highs with a bearish engulfing candlestick. As price continues down, it breaks the swing low. This confirms that it is a bearish trend. Now we can enter when a new level is created, such as a fair value gap. Enter at the retracement with your stop above the high and target the levels lower. Finally, we'll go over an example of trend continuation with trend lines. Here we can see price coming from a downtrend. At one point, it started to change course and move higher. Then it came back down and filled the inefficiency before retreating back. This gives us two anchor points where we can connect a trend line. Now all we have to do is wait for price to return and touch the trend line area. As price approaches the trend line, we can see that it went slightly below the trend. However, it did not have momentum behind it, or energy, which is what you want to look for a true breakout. So as we wait for price action, we can begin to see a bullish engulfing candlestick paint. You can enter long here or wait for more confirmation. As the market moves up, it has created a new higher high. This gives you extra confirmation that it's bullish. So now you could enter here on the retest of this resistance area, which has now turned into our new support level. Stop losses set below and target the levels higher. We have only one more example, and you don't want to miss this, because trend lines can be areas of liquidity. In this example, we can see the market is in an uptrend, as indicated by the higher highs and higher lows. If we know that the market is bullish, you want to wait for it to reach an area of support before entering along. In this case, we can see a fair value gap just below these lows. We want to wait for the market to take out liquidity down first before reaching these highs, which we can identify as trendline liquidity. Trendline traders will have this trend line to act as resistance. This area will likely have liquidity resting, as the traders who are short have their stop losses set just above this trend line. Since we know that the overall trend is bullish, the probabilities of a trend continuation are much higher. So we'll wait for the market to retrace and enter once it reaches the fair value gap. Stop losses set below the fair value gap and take profits set at the levels higher. Now that you've added trend lines to your tool belt, go forward and try these out yourself. If you know a trader that might benefit from this video, please share it with them. Don't forget to leave a like and comment in the video of what topic you'd like to see covered next.